In this video, I'm going to teach you how to finish building the ultimate subscription box financial model that you can use to scale your e-commerce business. We'll cover how to build the income statement showing the most important KPIs for e-commerce, inventory forecast, working capital position, and runway. By the end of this video, you will have a full financial plan for your subscription box business. And by the way, if you missed part 1, in that video, we covered the acquisition and retention model, which we'll be building on top of today. Okay, let's get started. Okay, so welcome to part 2 of the ultimate subscription box financial model series. In part 1, in case you missed it, we forecasted a supplements business that is selling to transactional ad hoc customers and subscription customers. We forecasted their unit economics, which is usually different for subscriptions versus one-time buyers. We did a marketing and CAC forecast. We also projected the conversions and retention behavior of ad hoc for subscription customers, calculated all the revenue, all of the COGS, contribution margins, LTV, LTV minus CAC, and some other key KPIs. You can see everything we did in part 1. I'm going to include a link to it in the description below, and it's also all in this tab. You can download this entire model completely for free in the description below. And today, we're going to cover part 2 and part 3. So in part 2, we're going to consolidate everything we did in part 1 into an income statement for a subscription box financial model business. Then we are going to be projecting the rest of the operating expenses. So I'll show you a really simple way to do and build a payroll forecast for your business. Then we're going to project all of the non-payroll expenses, so all of the other things that go into a business outside of marketing and payroll, enterprise software, consultants, etc. And then we're going to calculate your operating profit and your net income. And then in part 3, with inventory-based businesses, so CPG businesses, inventory is the thing that will make or break your profitability and your cash flow. So a lot of businesses go broke because they incorrectly manage your inventory and they run out of money, even though people want to buy their product. So it's important to have an inventory forecast and tie that back into your balance sheet and cash flow so you can manage your cash and working capital position. So we're going to cover an inventory forecast that's linked back to all of our projections, cash outflows. We will make a mini cash flow statement tracking our cash, and then we will look at working capital and runway, which means how much cash does your business have left to survive before it runs out of cash in the scenario that it's an unprofitable business. That's really, really important, and I will show you how to do that. Okay, so let's dive straight into part 2, which is the income statement. So let me show you how to do this here. You'll see a lot of data already. This is data that we covered in part 1. So first off, here are the key metrics and KPIs that I would report out if I was running a subscription box business. This is modeled after a supplements business. And so you have your annualized run rate, which we're pulling in from this tab here. And what this is just your revenue multiplied by 12. So we are saying that we are on a 12-month run rate of $43,000. Then we have our CAC, overall LTV. Then we have our LTV divided by CAC. So we're saying our CAC is $100. And our weighted average LTV between a portion of our customers being ad hoc customers and the other portion of our customers being subscription customers is $109. So what this means is that our LTV to CAC ratio is just 1.09, very low. Anything under 1 means you're upside down on your customers. And in terms of total dollars, your LTV minus CAC here is $9.2. So you can see that your LTV is just slightly higher than your CAC, but these numbers are improving over time. So you see your LTV slowly going up, your CAC slowly going down, and at the end of 36 months, your LTV to CAC ratio is 2, and your LTV minus CAC is 62. So now your business is much, much healthier. So let's dive into how I would sort of present the income statement. Again, we are just pulling in all of the metrics that we built in part 1. So you can see that our revenue split in the beginning is only 32% subscriptions and 68% ad hoc. But if you're a subscription box business, you want all of your customers to be subscription customers. So we want the subscription percent to be going up. So you see here that it's going up and up and up and up and up, and it eventually gets to over 80% of our revenue is being driven by subscriptions. Now, this should be the goal of your business if you're running something like this. Now, let's talk about gross revenue. So I like to present gross revenue and net revenue just so you can see sort of like what's the bridge that gets us from one to the other. So of our gross revenue, how much went out due to refunds or returns, and then how much of the revenue did we discount off? So you see here gross revenue is 4,200 and then it gets to 36, and that's our net revenue. Now inside of the net revenue, you see a split between first-time customers and returning customers. So you'll see that the returning customer revenue is going up over time, up and up and up and up. And remember, a returning customer generally has little to no CAC associated with them. So that is really where you're going to drive your profits from your recurring revenue. So in the end state, a business, especially if it's a subscription-based business, needs to see most of their revenue coming from subscriptions or repeat customers. And that's what we see here at the end of 36 months. So the unit economics of this business are improving. You can see that the contribution margins overall, they're slightly going down. And the reason is because the subscriptions have a slightly lower contribution margin as a percent of revenue because they get the bigger discount for subscribing. But then they generate more profit over their lifetime. So this is what we would expect to see. And finally, my favorite metric is the post-advertising contribution margin, or you could say post-marketing. And the reason why is that if you take your contribution margin and you subtract marketing, if you're not making a profit, it's a metric that is related to your LTV minus CAC. But if you can't make any money after marketing, you'll never have any profit left over to pay the OPEX of your business. So the payroll. So if your contribution margin minus marketing is negative, you'll never make a profit. So this is another very key profitability metric that I do not see that many businesses track, but I think every business would benefit from tracking. And I haven't linked in the advertising below, so let me just link it in here. So I'm just linking it over from the first tab. So you can see here, we have our advertising spend, which I linked in. So you see your contribution margin is increasing over time. And if we subtract the advertising from that, there's actually no mathematical way for your business to be profitable until month 11. But your total OPEX would still have to be smaller than this number for your business to turn a profit. So this number needs to get big if you have various employees and other expenses. So you can see now by month 36, we're starting to get to some very large post-advertising contribution margins. And so then you would guess that this business has a shot to become very profitable. So today, let's focus on doing a payroll forecast that's very simple, then forecasting the rest of our OPEX, and then taking that down to the operating profit level. So here's how I recommend you do your payroll forecast. I would create just a couple functional areas. You could say marketing, creative, operations, admin. Depends how many people do you have in-house and how many people do you have as consultants. A lot of subscription box businesses, for instance, when in the beginning phase when they're scaling, like they don't have an engineering team in-house, they outsource everything, but they usually have, sort of their marketing and creative people in-house. So this just, use this as a template. update this with however your business is going to work or is working today. And what you do here is you can put an average salary for this bucket. And so I just put in some kind of arbitrary numbers here for salaries. And then down below, here is how you make a really simple forecast. So you just create these same 4 buckets, marketing, creative, operations, exec, or whatever they are for you. And you just say how many people are in each department. So I said in month 1, we have 1 marketing person and 1 exec. And then the 25% benefits, taxes, etc. So if you look at a regular employee, their salary, let's say it's $10,000. Usually there's about 25% on top of the salary in additional costs. So the cost of the employee is actually about $12,500 when you include payroll taxes, healthcare, whatever it is, depending on the country you're in. So an employee usually costs about 25% more than whatever their compensation is if they're offered sort of all the benefits. Okay, so we have the 25%, and then we have basically said that in month 4, we're going to go from 0 people on the operations to 1. And then in month 13, so at the end of the first year, we're going to bring on an in-house creative person. And we said we're going to have 4 people trying to scale this business after that. Maybe you'd need more people. Maybe you would need less. I'm not sure. But this is a way that you can use to basically do a really simple payroll forecast. So once you have the headcount numbers, here is how you convert that into financial numbers. So what you do is you take the salary, you divide it by 12, so that gets you your monthly salary, and you just lock this column. So you put a $ in front of the A, and then you just multiply it by how many people are in that department. So 1 person. So you have 1 person who's making an $80,000 salary divided by 12. So the cost is $6,000. So if you just take this formula and you just multiply it, you can multiply the exact same formula, not only down, but across. And as long as you keep that 1 column locked, so you see this $ in front of the A, it means that even if you copy and paste this formula to the right, it's still going to be referencing column A, but it's going to change the reference to how many people are on the team in the headcount assumption down below. So this will get you your full sort of payroll forecast, and then what you do here for the benefits, taxes, etc., is you just take the total monthly payroll and you multiply it by your 25%, and so that's all of the extra costs on top of the payroll. So you have $16,000 per month, and so you can just use this to do kind of a quick and dirty payroll forecast in the model. Sometimes people, when they build payroll forecasts, they'll build these like multi-tab, like 700 row long payroll models. Please don't do that. Like, it's a huge waste of time, and don't do it unless it's absolutely necessary. Okay, so this gets you a payroll forecast. So now you're looking here, we look at our post-advertising contribution margin. So in the first months, you're like, okay, well, this number has to be bigger than the payroll for us to be able to pay the payroll. So it looks like in about month 15, or maybe month 14, we have some money left over to pay our employees. Okay, so that's a good thing. So now we have the ad spend. We already linked it in from our customer acquisition tab, which we put in as an assumption in part 1. And now we have just the other OPEX. So I'm saying other marketing, consultants, software, miscellaneous. In a real company, you can turn this into as many rows or accounts as you want. Maybe you have legal related to a certain thing, legal related to another thing, legal related to another thing. You can have many different breakouts of every single thing, but this is the basic structure. So expand this as you see fit. So what I do is I just copy these 4 accounts below into the assumption section, other marketing, consultants, software, miscellaneous. here, and then I just fill in the numbers manually based on my guesstimates of what this business would need. So I'm like, okay, other marketing, maybe we're doing some influencer payments, or we're doing some branding work with some consultants or whatever it is. So I put in a budget here. Then consultants, I showed the consultant budget going up. Maybe we're, using a lot of, 1099 consultants to do different stuff, so we don't have to bring people on full time. Then we have software and miscellaneous. So I just sort of forecast these numbers going up over time. And then all you need to do is you just reference those numbers below, and you just Control C, Shift, right arrow, right arrow, right arrow, right arrow, and Control V, paste. So you can see now that your other OPEX gets to 627, but again, that includes your marketing. So your total OPEX here is payroll, or the total personnel expense, plus all of the other OPEX. And so it goes up and up and up. And what we're really focused on here is our operating income. So let me expand these columns just a little bit so we can see the numbers. So operating income is your gross profit, aka gross margin, aka contribution margin. They all mean the same thing, basically, minus your operating expenses. So we have our contribution margin, 2,300 minus 38,000 of operating expenses. Okay, so we lost 36,000 in terms of operating income. And so our operating income is also called earnings before interest and taxes. So you'll see people call it EBIT. So operating income, aka EBIT. The reason I'm talking about all of these synonyms is because they confused me when I was first learning this. So I want to just put it on your radar that if you see EBIT and you see operating income, it's the same exact thing. So you see our EBIT margin is obviously negative. So it's negative, negative, negative. Does our operating income turn positive? You'll see it happens in month 17. So that is the point at which our contribution margin exceeds all of our operating expenses. So 8,500, we hit a 2% margin, and then we scale, 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 and we eventually get to a 19% margin in month 36. So this means we're making money, right? We're good? No. It absolutely does not mean that we're making money, because we are running a CPG business. We have to buy huge tranches of inventory. And your inventory purchases don't show up on your income statement. So the income statement requires you to match the unit cost of the inventory with the revenue from the sale of that unit. So if you collect $60 in revenue from the sale, you need to put the unit cost of, say, $20 on the COGS. Now, on the cash flow and balance sheet, you're tracking the actual cash. The inventory doesn't care about the cash. The inventory cares about matching costs with revenue. So the cash flow in the balance sheet will show you, how much cash went out to buy all this inventory, how much cash is then coming back in when you sell it, and that's why we need both views in order to run this business. And the one thing I just want to show you really quick that I included in the model is something called the tax loss asset. So all of the losses that you accumulate over time, you can use to offset future profits. So if you had $1 million in losses, your first $1 million of profits, you won't have to pay any taxes on. And it's only after your profits equal your losses that you start paying taxes. And so I like to track how many losses have we accumulated, because that is an asset to me, because that's a tax offset. So what I do is I track, all of the losses over time cumulatively, and it's not until your profits have paid back all the losses that you start paying taxes. So you can see here, only if row 66, your tax loss asset, is greater than 0, do you start paying taxes at 25%? So it's just good to know, because some businesses would say, oh no, like we're starting to turn, profits, we're gonna have to pay taxes. And actually this business doesn't have to pay any taxes for about 11 months straight. And so it's good to know that. So your net income is your operating income minus your taxes. So you can see here that obviously it's negative for a while and then it becomes positive. I want to thank the sponsor of this video, OrderGroove, a platform enabling a lot of brands to increase retention and reduce churn. OrderGroove helps enterprise and fast-growing e-com and retail brands grow recurring revenue and build long-term customer relationships. The leading brands in the e-commerce space have chosen OrderGroove to power their subscriptions, including companies like the Dollar Shave Club, La Colombe, L'Oreal, PetSmart, and many more. If you're doing over $1 million in subscriptions and need advanced capabilities like prepaid, memberships, and bundles, or if you're on a homegrown system and want to save on your technology costs and innovate faster, then come book a demo with OrderGroove today to learn about how you can take your customer retention to the next level. And if you use the link in the description or mention my name, you'll be eligible to receive 10% off your annual contract. So now what I want to do is start to think about cash in and out, and start to think about our inventory forecasts. So let's go back to our sequence. So we have consolidated the revenue and the COGS into the income statement. We forecasted the payroll. We forecasted the operating expenses, and now we calculated profit and net income. So let's dive into part 3, where we talk about inventory, cash flow, and working capital forecast. This is pretty quick because I'm going to keep it super simple, as if we only have one SKU. Obviously, the more SKUs you have, the crazier your inventory gets. But I want to show you the basic strategy and cash flow dynamics that you should expect. So first, let's go into the inventory forecast. So let me zoom in on this, and I will show you how this is basically working. Okay, so first things first with your inventory forecast is what you need to do is just pull in your orders. You need to know how many orders are that you're forecasting that you need to fulfill. So we can get that, fortunately, straight out of our income statement. So we've already projected total orders. So if we go into our acquisition model, you can see here we've added up all the orders. So these are the orders from your sort of ad hoc transactional customers and your subscription customers. So 50, 116, 194. So basically we need to have enough inventory to fulfill these orders and to look forward and to be able to fulfill those orders. So here's how many orders we are expecting. Now, there are two things that we need to be thinking about. First off, you have a lead time. So when you go and you order inventory, there's usually a lead time of at least a couple months from when you order it and to when you can get it to your fulfillment center. Then after that, there's a certain amount of time that you cycle through the inventory. So we're saying that's 4 months for our business. Lead time is 3 months. Cycle time is 4 months. So this is really important. So let's think about this. So if we need to order inventory today, that inventory won't arrive until 3 months from now. So if we order it today, it's going to arrive 1, 2, 3. It's going to arrive in month 4. So inventory 3 months from now. And then we're going to sell through that inventory in 4 months. So that's what we're targeting. We want to order enough inventory today so that the inventory that arrives 3 months from now lasts us for 4 months. And let's say that our starting inventory is 5,000. Okay, so we have 5,000. And so we start with 5,000, and to figure out how much total inventory we have, we basically take our starting inventory and we subtract how many orders we've sold. So we have our starting inventory minus orders we've sold. So we have 4,950 units at the end of the month. Then at the start of the next month, we have however much inventory was left at the end of month 1 minus the orders. So we have 4,800. And so our new inventory that we ordered in month 1 doesn't arrive until month 4. So then that inventory arrives, and so that gets added back to our total. And then we are selling through orders, selling through orders, selling through orders. And then we make another inventory purchase order in month 5, but that arrives in month 8. So here you can see that we have the same strategy. Every 4 months, we try to put in a PO. You might have to find that you have to do POs every single month. But in this model, we're saying that we're doing it every 4 months. And so we're needing to really anticipate demand well into the future, and that's why a really solid financial model is insanely valuable. So, okay, we need to be purchasing 2,300 units, then 6,800, then 15,000, so on and so forth. Later on, we're having to purchase over 100,000 units. So what is the cash impact of that? So here's basically how we need to think about this. So we need to take the product cost and pull it into the model. So in our model, we have the unit economics from part 1, and we have the product cost of our transactional product is $7.70. But we do actually have a mix where we have a product cost that's slightly lower for the subscriptions than the transactional. I'm going to take a weighted average between the two just so that we don't get too complicated. And then I'll show you how to forecast the cash. So we have the 770 for the transactional customers. And then for our subscription COGS, we had 650 for the product COGS. So I need to basically take a weighted average of these two. So that's 650. So to do a weighted average, I'm just going to say orders percent transactional, orders percent subscription, just so that we can do this weighted average without getting it too complicated. So what I'm going to do is I'm going to go back to my forecast for transactional versus subscription, and I'm going to say, okay, how many orders did I have that were subscription divided by what were the total orders running through the business? So the total orders were here. Okay. So that was 40% were subscription and transactional. And say, okay, how many orders did I have that were transactional? That was 30 divided by how many total orders did I have? 50. So you'll see 40, 60. So this will allow us to basically do a weighted average here. So let me just show you how I would do that. So I would say, okay, 60% of your order COGS are coming from transactional customers, and 40% are coming from subscription customers. So the average manufacturing and packaging COGS are 720. You can download this model completely for free in the description below if you want to check this out and go through the formulas. And if you have a question, just please drop it in the comments below. I'm happy to dive deeper in and talk about these dynamics with you. Okay, so it costs us about $7.20. We need to buy about 2,400. So the way that we actually calculate this is we just multiply them together. So 2,400 times $7.20, that should cost us about 17 grand. So if I multiply this formula forward, you'll see that every 4 months, basically we need to come up with, in month 5, 47 grand in that month to buy inventory that we're not going to receive until 3 months from then, and then is going to last us for another 4 months from that date. So this is why e-commerce businesses are so tricky, is because they have a hard time financing their inventory, especially early on, when they don't have a long history of revenue. So nobody really wants to finance the purchases for them. So now I have these cash outflows. And so we need to go back to the income statement and sort of full model tab and figure out, okay, so what do we do with this information? So at the end of the day, I'm just trying to figure out how much cash do I have total. So to do this, I need to calculate a very mini cash flow statement. So it's not a full cash flow. It's a cash flow that just calculates our cash. Like if we have other assets and other liabilities, I'm not that worried about it. I'm worried about our inventory versus our net income. How much money do we actually have? So here's how it works. First off, I'm going to say that we raised $500,000 to start this company. So we basically start with $500K. The cash flow statement starts with net income. So you pull in your net income and you say, okay, we lost $36,000 of net income. What that does not reflect is the cash that we needed to buy all of the inventory. So you have your net income, and then on top of that, you have the $17,000 that went out of your business to buy the inventory. So we link that in from here. Now, the things on your income statement that actually boost your cash is when you're selling through inventory that you already bought. So it says that we lost $36,000. Then on top of that, we spent $17,000. But what we do is we take our product COGS and actually we add that back to the net income. Now, the reason why is because that's actually not cash going out. Once we have the inventory, it doesn't cost me $7 if I sell it to you tomorrow because I already bought it yesterday. So that's actually cash in from a cash flow statement standpoint. So I take my net income, I back out all the inventory purchased, and then I add back all the inventory that I sold, the cost of it. So your true cash change in month one, and by the way, if you're unfamiliar with three-statement financial models, I have a great video about three-statement financial model. I'll link to that in the description below. I also have a three financial statement breakdown for e-commerce businesses where we go really deep into free cash flow and the cash flow statement. So I'll also link that in the description below. So real cash out of the business was $53,000. Then in month two, you'll see that the real cash out of the business was $37,000. So it was actually slightly less than the net income says because we're selling through that inventory. And so you'll see that while your net income is this really smooth looking number, your real cash dynamics are much more choppy. And so, it says you lose $54,000 in month 8 cash out and then $154,000 in month 9 because you need to repurchase inventory. So if we start with $500K, what we're looking at is at the end of that month, $53,000 of cash goes out of the business. Next month, $37,600 of cash go out of the business. So if we watch the runway, you can basically see that we run out of money by month 8. And then in month 9, we have to buy $100K of inventory more. So what does this mean? This either means that we are going to need more money in the beginning or we need more cash infusion around month sort of 6, 7, 8. But what I really want to look at is how low does our cash go? So looks like it goes, negative. This is basically what the business needs. So $600K. So the business is going to consume total, let's see. So over the first year, $690,000, and then cumulatively by month 24, $680,000. So the business kind of needs $750K or maybe $1 million total to get to profitability. So let's say, in month 6, we're like, okay, we want to raise another $500. Let's say we're able to do that. So at that point, you can see that this gets us to, our cash balance gets a little low, gets down to 99,000. Oh, and then it goes negative again. So actually that's not enough cash. So we would have to look at raising a bit more cash. So we would need another cash infusion by month. Maybe let's say here we target 750K. Would that get us there? Okay, so yeah, you can see this gets us to a point where our cash starts going up again. So total, the business needs to raise about $1.5 million to get to profitability. And at the end of year 3, it's a business that's doing in net income $230,000 per month, and in revenue about about 1.6 million in net revenue per month. So that is basically how you combine your inventory forecast in a really simplified way and convert that into a working capital forecast, take your net income and your income statement and connect it all together to build and scale a successful subscription box business. Okay, so I hope now you understand how to build a full subscription box financial model for your direct-to-consumer e-commerce business. Now, if you missed part 1 where we built out the acquisition and retention model as well as revenue and COGS, I've linked that in the description below. Also, if you want to download this model, you can download it completely for free in the description below. Thank you for watching, and I'll see you in the next video.